All right. So in chapter 7 today, what we're going to be covering is Sarbanes-Oxley and internal control. That is some of the primary things that we're going to be covering. We'll talk about the reasons why we're covering this and some of the things that happened in the early 2000s that created all these issues to why we need to cover this sort of stuff. So first we'll describe what the Sarbanes-Oxley Act of 2002 is and the impact on internal control, and basically what that is. Then we'll talk about, describe, and illustrate the objectives and the elements of internal control, what they're really trying to do there. These are some of the things that you'd actually go into when you take auditing, you take a look at a lot of those things that you're checking for this internal control. And then also internal controls to cash, making sure that there's different controls, separation of duty, those type of things there, and the nature of bank accounts and its use in the controlling of cash, how that's done. So we'll also talk about reconciliation of cash, controlling that, and then talk about the special purpose cash funds, those type of things there. And then we'll illustrate cash equivalents in the financial statements where those cash equivalents are. And then finally, we'll talk about the cash expense, the access, and the ability of companies to continue to use the business, cash in the business, the ratios there of cash. All right, so the first thing. I'll give you a moment to take a look at this and read this up here. You'll hear me tonight speak a lot about Sarbanes-Oxley, what that means. Now, it only refers to, as you can see there, publicly traded companies. Those are publicly traded companies that are here in the United States that are under SEC guidelines. And primarily the purpose of this is that public confidence and trust. Because we want to make sure that the investors they can trust that, otherwise they won't invest, right, in these companies. It'll just slow our markets down, slow a lot of our economy down. So one of the things is you put these controls in to help with this. So we'll talk a little bit about what those controls are and what they do. So Sarbanes-Oxley requires companies to maintain strong and effective internal controls over the recording of transactions and the preparation of the financial statements, to the point where if you don't do some of those things, it can really be detrimental to your company and possibly the leadership of that company could be an issue there. So internal control is broadly defined as the procedures and processes used by a company that safeguards its assets, processes information accurately, and then ensures compliance with laws and regulation. There's continual laws and regulations coming forward every year for new things that are out there. And so some of that is because of things that have happened in the past. And we'll start right here with this. And this is the Enron, Tyco, WorldCom, all that at that time frame. And Enron really led to this. And so some of those things that could be, some of the issues that, and things that we've changed are because of these things that have happened in the past. So there was concern about these type of things, and we'll talk about what the safeguards are and to help with some of these things here. Does it prevent anything from happening? No, not at all. I mean, what we're trying to do is provide a better system to separate those duties and make it a little more difficult for things like that to happen. That's what this is about here. You can't totally safeguard it from everything. And this is the basic information about the Sarbanes-Oxley Act, and I'll let you read through that in your book. You can catch up on that. All right. So internal control is a safeguard of assets, and that's what we'll be talking about here. And then the accurate information, making sure that we have accurate information put out there, because people are making decisions on if they want to invest in your company, give you a loan for that company, and those type of things. So we want to make sure that they have accurate information on those financial statements, and then compliance with laws and regulations that are out there. All right. Now, one of the issues that comes up is it can be employee fraud, and that's where there's a lot of concern is with employees. It is obviously the intentional act of deceiving an employer for personal gain, and so that can happen. And so some of those things are having those systems in there to make it more difficult, where it would take more than one person to do that. It would take a collaboration of several people. And so, but it still can happen, but that's some of the safeguards that are out there, and we'll talk about what those are as we move through. So the management is responsibility for designing and applying 5 elements of internal control that meet 3 internal control objectives. And so let's go through these here. First, to control the environment. Make sure we control the environment in a way that doesn't allow for that to happen. Risk assessment, really taking a look at what risks we have out there as a company. And then also your control procedures. Procedures that are used, potential monitoring issues and taking a look at that and how often you do it and how you do it. And then finally, information and communication. Those are our elements there that we're taking a look at. All right, so control threats. Now some of them, as you take a look here, there's lots of things in the environment that can be out there. It could be outside the organization or inside the organization. And so we have to take a look at all of those things. And that's why we'll talk about independence for the auditing committee that you even have for your internal audits, and then obviously an external company that may come in and audit you. So the control environment is the overall attitude of management and employees about the importance of controls. So there's 3 factors that we just talked about. I'm going to go in a little more in detail on those. So the control environment, first is the management philosophy of the operating cycle. What's their philosophy, and those are some of the things, what they focus on as a company. Then you have your company's organizational structure. And then you have your personnel policies. Those things are very, very important to how your company will be. Because if you have good leadership that values ethics and doing the right thing, most of the time it funnels down, and that's how your employees will be. If you're the other way around, and you do things more on the borderline, your employees will be that way too. And so setting the mission of your company and your values is very, very important in a positive way. So this is a diagram of the control environment. As you can see here, it starts with the CEO that feeds down, and then your policies are a part of those things that set that for the company. If you don't allow that to happen, you set those policies for employees that make unethical decisions and go to a different route, and you have strict penalties on that. Your employees probably won't do that, right? And so, but if you don't, well, that leaves the door a little open, and there's a potential that they could do that. And then also how your philosophy and your operating style, how you do things as a company. All right, so some of the control procedures, we want to basically provide reasonable assurance that we reach the business goals, and they may include, obviously hiring the right people, putting them in the right places, and then rotating those duties, and then provide mandatory vacations. So what we're doing there is basically put the right people in place, not having them all do the same thing over and over and over again, because if you do it over and over and over again, there could be an issue. And then having them take the vacations. And then separating responsibilities for related operations. So the person that taking the cash at the cash register at the store, takes the cash in, shouldn't be the one depositing the money, right? Because some of that may disappear in the transaction there. So having those separation of duties, that's what we'll talk about here, especially when we talk about cash handling and how that works. So separate the operations, custody of assets, like I just said, and then proof and security measures as a part of that. So threats. So a little we just looked at, we'll kind of walk through some of them here. So next thing is we're going to talk about is monitoring. So monitoring the internal control is used to locate weaknesses and improve those controls. So taking a look at those things, not just saying this is what we're going to do, this is what we're going to have, but actually looking to see how the processes work. And doing it in a way and looking to see where there's could be some issues. I'll let you read some of the warning signs there. I don't know if you can make those out. So these are some of the warning signs that you might see from an employee that something may be going wrong. Now, obviously, if you're changing your complete lifestyle, you all of a sudden have a lot of money. It could be an issue there. Now, this is warning signs for your problems with the accounting system. And so those are some of the things that you look at as the internal control there. So if you're missing documents, unusual increase in customer refunds, those type of things, you're looking at all those things to see what's happening there. Obviously, if you have lots of differences between your daily cash receipts and deposits, there's a big issue there. And even slow payments. Why? Well, sometimes employees might take the money in and help them float their bills, and then post it later. Those type of things can happen. So that's some of the things you got to be aware of. And look at internal controls. So internal controls can provide only reasonable assurance for safeguards, like I was telling you. Because there's also some other issues that can happen. Well, the human element of controls, those are some of the things that can happen out there. And then the cost-benefit considerations. Yes, we could probably try to stop everything from happening. What's the benefit to us by doing that? I mean, it costs us a lot of money to watch everything that happens. So does it really make sense for us as a company to do that? Probably not. But we have to do some things to follow in compliance with laws and regulations. All right, so we're going to talk about the internal controls for cash. So I kind of went over that real quick with you. I'll let you read through this. So cash is one of the easiest things to kind of hide. There's things that's a little harder for us to track. There's no trail. And so that's some of the things why there's such an important component of having controls over cash. So we'll go over some of the things that are required as a part of it. So businesses normally receive cash from two main sources. The first is customers purchasing products or services. And the second is making payments on account. Those are your ways of receiving the cash. So having controls over those are very, very important. Cash received from cash sales, you must protect the cash and over the counter sales in the cash register. So that's very important, make sure we do that. And then, as a part of that, cash received from cash sales, you can see here how it funnels through everything. Now, we must have separation of duties in here. Because that salesperson taking the cash shouldn't be the one putting it into First National over here. And so you'll see that the importance for publicly traded companies to make sure they have that separation. So a predetermined amount of money that is given to each cash register clerk is a cash drawer, is called a change fund. So that's what you start with. And then your control of cash receipts. Salespersons may make errors in making change from customers or in bringing it up. So that's why at some registers, they automatically spit out the change for you now. You've probably seen that a lot of the different registers where they'll spit out the change for you automatically, so they don't have that issue. As a result, the amount of cash on hand may differ from the amount of cash sales. That's short or over. That's what you are. So most of you guys have probably worked in retail and have a good understanding of how that works. So cash received from cash sales here is basically just the overview of which if you're over or short. So in here, we have a cash sales of $35,690, and then our what was left in the drawer was $35,668. So we're short a little bit, and that's what we would do as a transaction there. I would be a little concerned. I mean, yes, there's a lot of money, $35,000 to be off 22. It doesn't seem like a lot, but it is a lot. $22 is a lot of money to be off. Most of us, when we work in retail, if we're a couple pennies off, that's okay. But it's being a lot more, if you're in the dollar ranges, then there's an issue. So we'll find out what's happening here. So there has been, I'll let you guys read this, has been more cash over, cash short. that have been credited to the overage. So the opposite of what we had there. Now I'll let you read through this one. And so most of the time when you send a bill in, it's to a specific invoice. And that's what they're basically talking about here. And then you have electronic transfer funds, and that's how I pay a lot of my bills. A lot of people do also. You do it automatically through your checking account to pay those bills. That way you eliminate some of the middlemen as a part of that. And so some of the reasons why they encourage customers to use that, it costs less than receiving cash payments through the mail. Why? Well, it takes a long time for us to open it, and then take it to the bank, process it all, it automatically just comes in, and we're able to then process that way a lot quicker. And it also enhances internal controls over cash, since it's directly going to the bank and not going through employees' hands. And then finally, it reduces late payments for customers, processing cash receipts. It speeds it up. Now, control of cash payments, we want to provide reasonable assurance that payments are made for authorized transactions, making sure that they have had transactions there, and cash is used effectively and efficiently, too. We'll talk a little bit about that effectively and efficiently in a little bit here. Now, a voucher system is a set of procedures for authorizing and recording liabilities and cash payments. It may differ in either manual or computerized, so we'll talk a little bit about what that means. So a voucher is a document that serves as proof of authority to pay cash or issue an electronic fund transfer. So there may be a voucher sent out there as a part of that. Kind of like your POs that you may have to purchase something. Similar to that. We're going the other way. All right, so questions on this portion of chapter 7 here. Pretty simple stuff. We haven't gone through too many problems yet. All right, let's read about bank accounts real quick here. So those are some of the advantages of using bank accounts, and most companies do, obviously. Now, the bank statement obviously sends you a summary of what's happened that month, beginning balance, additions, deductions, and then you have the ending balance. Obviously, things change throughout the month, and so you have to reconcile that almost like you would your own bank account, making sure it's right. And so those are some of the things we'll look at also. So here's an example of a bank statement. You can see the squiggly line there, that's where it's been cut off, and these have been merged together. So you have lots of different transactions, and just because this says what we have doesn't mean it's what's going on, because we may not have made a deposit yet that we have, that we've already accounted for in our system, but we have not dropped it off there, or they have not processed it yet, or vice versa, a payment or something like that has not come through. So, impact on debits and credit memos here. This is what we think here, and this is what we have. Those are some of the things that can be a decrease in liability, and then an increase in liability. These are some of the codes that can be found on a bank statement. I'll let you guys read through those. Hopefully you don't see the NSF very much. All right, so using the bank statement as a control over cash, basically making sure everything balances out. So as you can see here, figure out why the differences are different here. And so that's some of the things that we'll look at and figure out what's going on, why it's not the same. And that because there's a transaction, something in, like I mentioned before, something happening in the transactions that have not processed. So those are some of the things you look at. All right, so the next thing we'll take a look at here is the bank reconciliation and controlling cash. So basically walking through what we just talked about there. So bank reconciliation, similar to, like I say, what you would do for your own checking account that we all used to do, but we probably don't do as much anymore. So taking that bank statement and making sure everything balanced out, what we use our money on, but this probably doesn't happen as often as it used to because we got that wonderful thing out there called online banking, and it keeps track of everything for us right away, right? So we know what's going on. But as a part of this, we still have to do that for internal controls because we want to make sure everything does balance out and figure out what's happening. So bank reconciliation usually divided into two sections. The first is the bank section, which has your cash balance, and then it ends with the adjusted balance. And then the company section that has the cash balance, and then ends with the adjusted balance on both sides of those things. So we have the bank's side of the picture, and then we have the company side of the picture. And so now we've got to figure out what the differences may be, what's out there hanging. And they should equal, right? We want them to balance. Both sides, they should be saying the same thing. Okay, these are the steps here of the bank reconciliation. So first you enter the cash balance, then you add your deposits that are recorded at the bank, and then you deduct outstanding checks that have not been paid by the bank. So we figure out what those are, and then determine the adjusted balance after steps 2 to 3. And then you have the company section of the reconciliation. Where we go into, we enter the cash balance according to the company, add credit memos that have not been recorded, deduct debit memos that have not been recorded, and then determine the adjusted balance there and verify that they are equal, that your 4 and 8 are equal there. So that's what we're looking at. Pretty simple, too bad. All right, so we're going to walk through the whole transaction and how this one works, and we'll do one in the book. All right, so in this one here, Power Networking Bank reconciliation, the bank statement shows that the ending cash balance of $3,359.78. So what we have here is that's our cash balance. So that's our step 1. So then step 2, you guys remember what that step 2 is? And the deposits, perfect. So we added our $816.20 deposits that is not recorded on the bank statement. So we add that in. And then we're going to take away our outstanding checks, which are these outstanding checks that have not cleared. So as you can see, there's several outstanding checks. We'll add up all those together to figure out how much that is. So we put all those in there, add those together, and then subtract that value from the value above. And so that gives us our adjusted balance. That's our step 4. So cash, add deposits, take away checks, that's our adjusted balance. Now we'll take a look at from the company side. So as a part of that, we start off with what we had, the cash balance, and then we'll look at the different memos that we have not processed yet. So indicate that the bank collected a note in the amount of $400 of related interest on $8 for Power Networking. So we add a note and interest collected that we have. And then we're going to take anything away that we have on the debit side of that. So check from a customer was returned because they didn't have enough money in it. And so that thing, so we have to add, also put in the fact that we have that $18 charge too. So we have the non-sufficient funds for that, $300, and the bank service charges of $18. Because previously we thought it was good, now we found out it's not good. So then we figure out what our totals are. Oh, the errors also, excuse me. So we have the errors here. Transpose the numbers, that's the difference there. And so there's an error in that check. And then we have our adjusted balance. Do they match? They match, that's a good sign. That's step 9. All right, so everything's good. So the journal entries for all of these things here is we would put those things that we just saw. So we have cash, received in from notes receivable and interest revenue, and then we have accounts receivable. He now owes us $300 again because of that. We have a miscellaneous expense here, and then we have accounts payable for $9 because of the change to that one, that error that was made. And many times what we would do is probably charge Mr. Ivy for this non-sufficient funds check. Maybe do it here. Most times we would do that. All right, so this is how it looks at bank reconciliation. Starting with step 1, moving all the way to step 8 and 9. What we just did. All right, so questions on that section? Pretty simple, not too bad. Pretty easy chapter so far. All right, so we're going to describe the accounting for the special purpose cash funds. So special purpose cash funds and what we do there. So petty cash funds, which you probably have heard of before, because a lot of times it's not practical for us to write checks for smaller things. We may have a small cash fund that is used. So you may put something in the petty cash for that. And so you started off, this is made the journal entries, that starts off that petty cash fund with a nice little amount of money of $500 you have in there. So we take out cash and put it into petty cash. And so that's specifically that account. Now that can be a problem account. The only time petty cash is debited is when the fund is initially established or when the fund is increased. So just be aware that the only time petty cash is credited is when it's being decreased, obviously, when somebody's spending money out of it. So that's basically what's happening there. So petty cash fund at the end of August, figure out where we spent our money, postage, store supplies, miscellaneous administrative expenses, those type of things, and then office supplies there. So we have $467 that's been used. That would give us $33 left over. And that is what you'd see there. Now, sometimes they use special accounts for that special purpose fund, so like payroll is used for travel expenses specifically for that. You don't want to touch your payroll, it should be separate from everything else. A lot of times companies have their own bank account for payroll. Just separate everything there for that, so they don't pull that money accidentally out of it. And so that could be a special purpose fund, that's what that's referring to. So questions on those type of funds, pretty simple stuff. Probably heard of both of those. So one last thing we want to take a look at is describe and illustrate the reporting of cash and cash equivalents in the financial statement. So we'll take a look at a couple slides here. So a company's excess cash is normally invested in highly liquid investments. What they mean by that is something that can be turned into cash quickly. So you're going to put in investments that you can pull in, so you may not put it into a 10-year bond or a 10-year note or something like that. You'll put it in something that you can turn into cash pretty quickly. Why? Because we may want to pay our bills with it, we may have an opportunity of expansion for it, but we want to be able to have that cash so we're able to do what we need to do when things come up. And so, that's what you see a lot of times here. They'll sometimes say cash or cash equivalents. So sometimes it might be in a market or something like similar to that where they can just pull it right out. Now, as part of that too, banks may require depositors to maintain the known cash balances in their bank accounts. Such a balance is called a compensating balance. The reason being is, if you get this loan from us, we want you to hold $10,000 at all times in that bank account. Don't go below that. And that could be a requirement for the loan. If you happen to dip below that, therefore, you then default on your loan. You may become due. And so that recently happened early last year with JCPenney's. They dropped down too low in one of their cash accounts, and all of a sudden this 20-year bond they had was going to come due. And it was going to be a big problem. So that was some of the things that they had to figure out as a part of that. So that could be required as part of giving a loan. All right, questions on that? Simple stuff. All right, so describe and illustrate the use of ratios of cash to monthly cash expenses. So basically we'll take a look at here, have we been able to pay our bills? So a cash ratio that is especially useful for startup companies or companies in financial distress is a ratio of cash to monthly cash expense. So this ratio is computed by using this following equation. So this equation here, so cash at year end, and then your monthly cash expenses. Let's figure out what we have. And then you have your ratio of cash to monthly cash expenses here again. So it includes all cash equivalents as taken in the balance sheet for the year end, and then monthly cash expenses, sometimes called cash burn, are estimated from the operating activities section of the statement of cash flows. And so you have your monthly cash expense equals the negative cash flows from operations divided by 12. Those are a couple of ratios that they do sometimes look at, especially when they're, again, starting with looking at startup companies. So in Chapter 7, we have covered a bunch of different things about cash. We haven't done a lot of breaking down numbers, but we've looked at a lot of things of the importance there of internal controls and then also cash as a part of the company. And making sure that we have a separation of duties there. That person that's accepting the cash does not also make the deposit. So you'll see a lot of companies may appoint somebody else in a different department to deliver the cash to the bank as a part of it. So yes, there still could be some collaboration and potential for problems, but it's a little more difficult than it was before when you can just have the same person taking the cash in, same person taking the cash over to the bank. So questions on Chapter 7.